welcome everybody, and thank you very much for your time today. We're very excited to run this session. It couldn't be more timely. We did purposely put this on for the start of the new financial year because it is all about tax tips for property investors. So we're very pleased that you're able to join us today, and we're looking forward to a really great session with you. Just some tips around those that may or may not have used Zoom. I'm sure most of us are probably familiar with these programs now, but be aware that if you have your volume please turned up. You're unable to make any sound or video with that. We've disabled that for purpose, so there's no heckling. But certainly you do have the opportunity to take part in Q&A. There is a tab down the bottom there where you can ask questions, and we'll absolutely endeavour to answer those either during the webinar or towards the end with our colleagues. So kicking off now, I'm really excited to introduce our special guest for today, first led by our Managing Director, Sam Khalil, who many of you have likely met. Sam has been running DPN for over 20 years and been working in property and finance all across that time, and is certainly seen as an expert in his field. So we're very pleased to have him and share his expertise around what the strategies are for building wealth for property investors. And we're equally as excited to have Rizwan Inayat with us today. He's the Director of ITrust Tax Accounting. He's a valued partner with DPN, and he brings more than 20 years himself experience in the tax industry, but he's been running his business for more than 10 years. And his firm specialises in tax services for property investors. So really pleased to have these two gentlemen along. They're certainly heavyweights, not in the literal sense, of course, but in the industry to give us some great insights around that. My experience, well, I feel like I've had more than 20 years experience with Zoom as it feels this year, but that's what it feels like as we've been working through remote pieces. So settle in, make sure you've got a cup of tea, and we're looking forward to taking you through the session today. Just before we do start, obviously we need to sort of outline upfront, is any good financial services organisation would tell you that this information certainly is not to be taken as advice, and it certainly needs to be specific to your individual circumstance, and we absolutely recommend that you work with your expert team, which we'll touch on that later in the webinar as well. But really important to notice that this is certainly an education piece for everybody. I wanted to kick off today with a few quotes that I came across in thinking about tax. You may have seen some of these, death, taxes and childbirth, and there's never a convenient time for any of them. Well, funnily enough, now is the right time, being the 1st of July. It is certainly the right time for everybody to get their affairs in order and look to get their tax returns sorted. Albert Einstein, one of the most preeminent figures in modern history, once said the hardest thing to understand the world is income tax. That's quite a hilarious thing. It's quite exciting to know that why we have experts to work with this as well. But I think my favourite quote really comes from Al Capone. They can't collect legal taxes from illegal money. And I'll preface that by saying today, there's certainly nothing illegal about what we'll be talking about today. Certainly we'll be talking about what you do need to be in terms of being compliant, but giving you those really good tips and insights about getting the most out of your property investment and its return. So before I do hand over to Sam and Rizwan, I just wanted to run a very quick poll for people to see where they might be and see those who might be keen. So there's a poll I'm going to put up here, and that's really around who plans to book their tax appointment with their accountant in July. Interested to see those people that might be interested in actually getting themselves ready to go now. I'm seeing those come in as we go. There's a fairly mixed response at the moment of people that are ready and some that aren't. Bulkily enough, they are. Well, funnily enough, we've seen that 7 in 10 of the people here today are actually ready to go in July. So again, timing could not be better. So that's wonderful to see that result. So what I would like to do now is certainly hand over directly to Sam and to Rizwan, who are going to start taking us through some of these great tips today. So Sam, I'll hand over to you.
Thanks, David. Really appreciate that, and a great introduction. So thanks everyone for joining us today, and thanks Rizwan for being with us. Certainly joining us at interesting times. I've now just about hit our 25th year in operation as a business. I still feel young, but I'm quite astonished by the time I've been involved in this industry. And I'd have to say, I have never seen anything like it. Yet, as I've always seen over the years through different crises and world events, life goes on, taxes continue to happen, and property markets continue to grow, and you might have some of these short-term fluctuations, and as dramatic as they may be, but there are still opportunities out there. And we've seen just over the last month, David and Rizwan, is that we've gone probably around from April, where it was sort of like an Armageddon scenario and everything looked crazy, to only a couple of weeks ago where the Prime Minister provided some stimulus for the property market, particularly around the construction sector, and it's completely swung around in areas that we've got clients going, and we've seen price increases, not reductions, and developers seeing things sell out in an amazing time frame. And our inquiries have been dramatically increased with people who do have work and employment with record low rates coming and investing in the market. So it's certainly a fascinating time, and I've never seen such a dramatic change in a short time frame within a month, going from something that looks quite alarming to now a great deal of optimism for those that are savvy, and they can get rates now. Again, in the 25 years of doing this, I've never seen loan rates, particularly for investment properties, below 3%, and able to get yields at 6%. So you're basically making twice as much as it's costing you just on the income side. But so that's the tone that we've got in this environment. But what we're talking about today is tax tips for property investors. And look, this will be fairly general and introductory. It's not super complex. There'll be some complex concepts we'll discuss today with Rizwan. But maybe Rizwan, starting off, what are the things? Take us to kindergarten in a sense. How are rent and property expenses treated in someone's tax return? What do you need to add to income, and what can you claim? If you could just sort of elaborate a little bit on that.
Thanks, Sam, and a quick hello to everyone. Simply, rental income forms part of your assessable income when preparing a tax return, and obviously the expenses that you incur on a rental property reduce that rental income, and you're in a position then where you either positive with your rental income and expenses, or negative, which then obviously gets declared in your tax return. Some of the most commonly claimed deductions when it comes to preparing your tax return are obviously your agency fees, council rates, water rates, strata, etc., etc. But from experience, when it comes to claiming tax deductions, what we find is usually the deductions that people miss out on. Some of the common ones I'll run through today. One of them is claiming borrowing expenses when purchasing a property. Borrowing expenses are things such as lender's mortgage insurance, all the costs incurred on the inception of a loan, stamp duty, etc., etc. That's not the stamp duty on the purchase, but the stamp duty on the actual loan itself. Mortgage discharge fee. We're finding that in the current environment with the low interest rates, a lot of people are refinancing their mortgages. So the discharge fee on a mortgage, including the actual penalty interest that some people pay when paying them refinancing early, especially if they're on fixed rates, they're all tax deductible in the year that you actually do the refinance. These are commonly missed deductions. Another deduction that is quite common is depreciation. If you've purchased a property that was built after September 1987, depreciation is something that you should be looking at, especially when it comes to the capital works component, which is the construction element. So usually what we do is we engage a quantity surveyor to prepare a depreciation report to work out these deductions. They're probably three of the most commonly missed deductions that we're finding with property investors when preparing tax returns.
Thanks, Rizwan. And I guess, what are some of the expenses you can't claim? Some people might think, when you purchase a property, like maybe things like stamp duty and, other costs, how are they treated?
Sure. There are certain expenses that are capital in nature, meaning that you cannot claim them in your tax return, and they only get claimed when you eventually sell the property, so they reduce your capital gains tax. Examples are stamp duty that you pay on the purchase of a property, the legal fees, solicitors' fees that you incur when purchasing a property, any sort of agent fees incurred when that's generally in relation to the sale of a property. But usually any costs incurred in relation to purchasing a property are considered capital in nature, which means they get claimed when you eventually sell the property at the end.
Okay, that's great. That's great. So you mentioned depreciation, Rizwan, and so I guess what's the value of that? You know, some people, and maybe if you could again explain, you know, how depreciation actually works, because people may have heard about that, it's vague, but mathematically and from an accounting point of view, what is depreciation? How's it calculated on property? And maybe, and I'm asking three questions at once here, and what's the value of it for someone as a property investor?
Look, in terms of deductions, depreciation is a really valuable deduction because it's a tax deduction that you get with, and it doesn't impact the cash flow of your finances. So it's essentially a deduction that you claim on paper. Usually when claiming a deduction, you actually incur expenditure, meaning that it actually affects your overall cash flow position. Depreciation is a paper-based deduction. To give you an example, if you were to purchase a newly constructed property, you'd be looking at a depreciation deduction anywhere from 12 to 20,000 from experience. For a taxpayer making $150,000 per annum, that equates to a tax saving of about anywhere from, it's a tax saving of 40%, so anywhere from $5,000 to $8,000 per annum
Per year.
Per year, exactly.
So on a new property, for example, versus an established property, because this is one of the biggest debates, you know, should you buy old, should you buy new?
Yep.
If you're saying you can get somewhere between, what was it, $5,000 to $8,000 a year in tax refunds over a 20-year period, that's a significant amount of money for someone, isn't it?
Exactly. And that's a very good point that you raised, Sam, because in 2017, the legislation changed whereby it's hard to now claim depreciation on the plant and equipment component of a property if it's a second-hand property, whereas with a newly constructed property, you're allowed to claim the plant and equipment and the actual capital works, which relates to the construction element. So the newly constructed properties are now the depreciation deductions are double, if not greater, when compared to a property that is not newly constructed.
Okay, so 2017, the law changed, and that again has a significant delineation between old and new properties.
Correct.
And from what you're saying is it could be at least $100 a week extra in cash flow from the deductions.
From experience, what we're finding is that the difference in depreciation of a newly constructed property versus an old property could be anywhere from $8,000 to $10,000 per annum.
Okay, yeah, that's a significant number. And so I think when you're looking at a portfolio, and this is what we encourage clients to look at, if you had 3 or 4 properties like that and you're building a portfolio, well, you know, that's $25,000 to $40,000 worth of deductions, and the cash flow from that is significant, which, you know, affects how you hold, you know, portfolio properties versus one property.
Correct, exactly. And also keeping in mind that depreciation is a deduction that you claim on paper. It doesn't have an impact on your overall cash flow.
Yeah, just elaborate a bit more on that, Rizwan, because people might think, well, how do I do that? So when you say that, you mean it's not like you actually have to pay an expense like water rates or council rates. It's built into the value of the property. Is that right?
Exactly. So just as an example, interest obviously is a big component when claiming deductions. So with interest, you physically have to transfer funds to the bank in order to claim that deduction. So there's an impact on your cash flow. Whereas with depreciation, if you're claiming $15,000 worth of depreciation deductions, that $15,000 isn't leaving your bank account. It's something that's essentially claimed on paper. So it's a deduction that you're essentially getting that has no impact on your cash flow position.
Okay, and look, we might discuss this in another question shortly, just with about gearing or negative gearing, but that's where sometimes you might make a profit on the rent, and you might be liable to pay tax on that rent, but the depreciation helps wipe that out, so you get that money tax-free. Would that be right?
That's exactly right. So you could be in a position where you're cash flow positive, but on paper you're negative. So essentially, you're not paying any tax on that property.
Yeah, that's great. So look, why don't we move to the next sort of tax that can affect people, and it's capital gains tax. And so That happens when it crystallizes when you sell an investment property and you make a gain. So maybe again, if you could sort of give us an idea of how capital gains tax works, how's that calculated?
So the capital gains basically is a calculation on the profit that you make from a property. So it's essentially what you sell the property versus what you purchased it for. There are certain costs that get added to the actual cost base of a property, which includes your stamp duty, your lawyer fees, your marketing fees when selling the property. These are costs that we add to the cost base of the property to work out your capital gain. So essentially it's a difference between the sale price versus the purchase price. There are discounts available to individual taxpayers that hold a property for more than a year, which property investors usually do. And that gives you a 50% capital gains tax discount. So just a quick example, if you buy a property for 500, sell it for $1 million, say the miscellaneous costs associated with the property in terms of stamp duty, lawyer fees, and real estate agent fees for marketing the sale of the property are 50 grand. That increases your cost base from 500 to 550. You've essentially made a $450,000 capital gain on that property, which is the difference between the 1 million and the 550. That $450,000 gain then gets discounted at 50%. So it reduces the overall gain from 450 to $225,000, which then gets declared in your individual income tax return, and you pay tax based on whatever your personal marginal tax bracket is in that particular financial year.
Okay, so if you're in the highest tax bracket, you're going to pay on that 225 gain, the highest tax rate.
That's exactly right.
If you're on the lowest tax bracket, how does it work?
So if, let's say, for example, in that particular year, you're working and you're earning a salary of $80,000, that income gets added to the 80,000, which means that part of that income will get taxed at the 38% bracket, and the part that's in excess of 180 will then get taxed at the highest marginal bracket. If, for example, you're not working in that financial year at all, then essentially the first 20 grand is tax free, and then it continues on from there based on whatever your
So some of the tax minimization strategies, if you're planning to sell a property, you're going to have a capital gains, is that you could do it in a year when you're not working, or you're retired, or maybe salary sacrifice in the super, I think, is another strategy where you can lower your income, and that's where you should consider the timing of selling a property, right?
Exactly. And it's critical to be really strategic in your decision making in terms of when you sell property. And as you pointed out, ideally you'd want to sell it from a tax point of view in a year where your income is low, and you can salary sacrifice and try and minimize that as much as possible.
But if you can, you probably want to encourage people to keep properties, because by the time you sell it, paid all these taxes and fees, you could almost use that equity to do something else.
Exactly.
Yeah, so you want to be very careful about selling it. But look, that's what you need to be aware of with capital gains tax. So if we maybe just go to the next slide, David, and that's around negative gearing or gearing, I guess. And, and I said in the 2.5 decades I've been in this industry, I've heard this term, and people have come to me and said, I want to do negative gearing. They haven't actually used the phrase, I want to invest in property. It's become part of our vernacular where people say, I want to do negative gearing, and their number one priority is to get a tax deduction. And, I just go through a process of educating them between, first of all, what gearing is, and gearing can be negative, neutral, or positive. But maybe, again, Rizwan, if you could sort of explain to people what gearing is generically, and the differences between negative, positive, or even neutral gearing.
Yep. So gearing is essentially borrowing to invest money. And you could be in a position where you're positively geared, meaning that your actual rental income exceeds the expenses on that particular property, which puts you in a position where you're positively geared. Whereas on the other hand, negative gearing is when your rental income is actually less than the expenses you incur on that property. And that includes obviously your interest, depreciation, or council rates, water rates, etc. What people need to be aware of is that when it comes to negative gearing, just as an example, say your property was negatively geared by 10,000. So meaning, let's say your rent was 30,000 and the expenses on that property were 40,000. So you're negatively geared by 10,000 in that scenario. That $10,000 equates to a tax saving of about $4,000 if you're earning a salary of $150,000. So essentially, you're only getting back $4,000, which means you're still out of pocket $6,000 on that particular property. So that needs to be factored in. So on the other hand, if that same taxpayer was positively geared by $10,000, he would be paying $4,000 tax on that property, but he's still $6,000 ahead in terms of his overall financial situation. So it's important to look at your strategy from a financial point of view, where tax is one particular aspect, but you want to ensure that the strategy works from an overall financial perspective.
So, as an accountant, would you encourage people to be negative geared or positive geared?
Look, essentially, the whole reason for investing in property or investing in general is to essentially make money and build wealth. That's the whole idea of why people invest. So we obviously, our advice as accountants is to help you minimize tax, but essentially if you're purchasing a property and it's negatively geared and you're losing money overall, from a financial point of view, that's not a good strategy at all. So you'd want to be focusing on the fundamental aspect of investment, which is to make money, essentially.
Great. Thanks, Rizwan. So, tax variation forms. Again, people may have heard of these, and this is where it allows you to claim back some of the tax you might pay on your income during the year. Could you explain how that works and when you would use that?
Look, generally we do tax variation forms for clients that are negatively geared. Essentially, if you are in a position where you're negatively geared, you tend to lodge your tax return at the end of the financial year and receive a lump sum tax refund at the end of that financial year. So you're essentially waiting 12 to 13 months before you're getting that refund back. By lodging a variation, it enables you to get that refund on a monthly basis through your payroll instead of having to wait at the end of the financial year. So it's a way to boost your cash flow.
Okay, yeah. So again, that would be in the instance that you are losing money on your properties, but if you're making money on your properties, you wouldn't need to do that.
Exactly. That's exactly.
Yeah, excellent. Look, again, I get a lot of people that come in and they say, I want a property that I can, lose money on. And I use the law of amplification. I say, would you like 100 to lose on? And then they say, no. I said, so would you prefer to have 100 properties making you money or 100 losing you money? And it's amazing what sometimes people excuse at a lower level, but when you amplify it, they may not realize it's that appealing to have. So let's move on to maybe entities that you can hold properties in, and that's trusts. And some people think trusts are sort of like some magical vortex where you should always hold property and it can somehow make taxes disappear and all that. But maybe if you can demystify that for us, Rizwan. And what are the trusts? What are some of the different trusts, and why would you consider? And who should consider them in holding property? Because they're not necessarily for everyone, are they?
Yeah, exactly. Look, when it comes to structuring, you need to be really careful and do your homework before setting up a trust structure. So usually, whether it's a trust or a company structure, some of the things that we look at are asset protection, tax minimization, and ensuring that the structure fits in within your overall goals of investing. Looking at trusts in particular, generally speaking, there are two types of trusts that we set up for property investors. There's a discretionary family trust that we set up, which is ideal for property investors that are earning positive income from their investments. It allows you to actually distribute income to beneficiaries over 18 who are on a lower tax bracket. So it allows you to split income amongst different beneficiaries. And also when you sell the property, any capital gains tax that you incur on the property can also be distributed out tax effectively amongst your beneficiaries. That's assuming that you have members within your family group that are on low tax brackets. Having said that, each structure has its advantages and disadvantages. When looking at a family trust structure, you also need to be aware of the land tax implications, and you need to ensure that your structure factors in the land tax-free threshold. Unfortunately, a discretionary trust does not entitle you to get the land tax-free threshold, which in New South Wales is about $740,000. So that is a big disadvantage with a family.
But that might change in other states, right, Rizwan? Because like, for example,
Correct.
In Queensland, each entity you set up there can get a land tax. So you've got to know the nuances of each state. Is that right?
Exactly. So land tax is a state-based tax. So each state has its own different legislation. In New South Wales, you don't get the threshold, but depending on where you purchase the property, in other states, that needs to be looked at in particular. The other disadvantage with a discretionary family trust is that for negatively geared property, any losses that are incurred are actually trapped within the trust and carried forward to offset any future income. So unlike when you're investing in your personal name, any negative gearing that you incur actually offsets your salary and wages or other income, and you receive an immediate tax benefit. That is not available in a discretionary trust structure per se. So it is beneficial for some people and not beneficial for others. So it really depends on your individual situation when it comes to setting up one of these discretionary family trust type structures. The other structure that's quite common when it comes to trust is a unit trust structure, which is generally common amongst unrelated parties investing together to purchase a property. Another scenario where a unit trust structure is quite effective is when purchasing a property with your self-managed super fund. So you can essentially hold a property in a unit trust structure where yourself and your self-managed super fund can own units within that structure and obviously hold that property.
Yeah, and we use that structures or that structure in particular when you want to get properties that you have to have construction in, because with super fund lending, it's quite restricted that you need an existing property. So that's where we could work around with that.
Exactly. And also, if a unit trust structure is structured correctly, you do get the land tax free threshold.
Oh, that's great. That's significant compared to a discretionary trust. So continuing our discussion on structures, then I think the other end of it would be good to canvass with you is a company.
Yep.
Why would you consider a company to buy a property versus a trust or someone's individual name?
Look, a company has two main benefits. One being the tax. Obviously, it's got a flat tax rate of 27.5%, and also it gets its own land tax free threshold. Now, just touching on land tax, in New South Wales, the land tax free threshold is $700,000 or $730,000. That in itself is a tax saving or expense saving of about $10,000 to $11,000 per annum. So it is a significant tax saving, and it's something that we look at very carefully when advising a client on what structure they should use. The benefit of a company structure is that any capital gains or any positive income that property makes gets taxed at 27.5%. It also has a significant benefit for clients that are operating their own business and that wish to retain earnings within their business and use that cash then for purchasing investments rather than the cash sitting idle. So if you're a business owner making a lot of money and not wanting to take that money out personally via salary or wage or dividend because of the personal tax brackets, a company structure is an ideal structure for you because it allows you to retain that money within your business, pay tax at 27.5%, and then essentially invest that in an asset.
Yeah, so I guess it's someone that might be in a position where they've, probably paid off their home or are earning significant amount of money above the highest tax bracket, which is, about 45 cents in the dollar when you add your levies and what have you. So dropping to 27.5 is a significant saving. It's over 30% saving in tax. So over time, there can be a benefit of holding assets within a company because at 27.5, that's lower than even the average tax rate of 30%, isn't it?
That's exactly right.
Yeah. So when you start to accelerate or get into a phase where you're wanting to build up significant amount of assets and income, companies can become useful, but they're probably more beneficial for people who are self-employed or have businesses than someone working as an employee. Is that right?
Yeah, generally speaking, they're more suitable to business owners. And with these structures, they're very specific to people's individual circumstances. So it's a matter of running through your scenario in detail and before giving advice on this. But generally speaking, company structures are more suited to business owners.
So, I mean, these last few things we've been discussing around is the entities that hold the property. And you talked about land tax threshold, which is really considerable, particularly again when we look at a portfolio. So again, what are some of the areas you've seen in this space, of people buying in the wrong name or entity? Because most people, when they buy a property, they only think about the first property, and they would buy them in joint names. It could be husband and wife or a couple, and what's the problem with that thinking?
Yeah, look, that's a very good point that you raised, Sam. It's critical that property investment is a journey, and you essentially the structure is the most critical element. So coming back to your example, if you were to purchase a property, say a joint tenants, husband and wife, 50-50, which we see quite often, the disadvantage with that is that if you've already utilized a land tax free threshold, the next property that you purchase in your own name, essentially you're going to be paying 1.6% in land tax on that particular property. Whereas had you purchased 100% say the husband purchases 100% and the wife purchases a property in her name 100%, you essentially get a go at that threshold twice.
So you get a land tax threshold each, basically.
Exactly.
But as soon as and this again, for the nuance in New South Wales, if you do that, you both only get one exemption to share between yourselves if you're both on the same property. Whereas if you've got properties in individual names, you get access to two thresholds.
Exactly. So your threshold, in other words, is 1.46 million instead of 730,000.
It's considerable.
That's a significant saving if you're talking $11,000 to $12,000 a year.
Yeah, I've seen that happen where people have rushed off and bought other things and not got their advice right and their structuring right. And then the problem is every year thereafter, they're up for a significant land tax bill. And if they want to swap ownership, they have to pay a massive stamp duty bill. So these are the challenges. So it shows getting the right structure and advice can have massive benefits or consequences if you don't. So I guess that brings us to our final slide here. And, look, you may have comprehended everything we spoke about, or you might have thought, wow, at the end of this, I really need to make sure that there are a lot of things to be aware of. And that's why we always encourage people. There's no one size fits all approach, and just getting information off the internet or even a webinar and thinking, look, I know what I need to do, and just go out and do it is very dangerous and can have considerable impact. And I guess, Rizwan, you as an accountant, again, what are some of the things you've seen when people don't have the right team around them? You need obviously someone to help with the tax advice, but we work as both a mortgage broker and a property strategist out of the four people here, and you'd use a solicitor or a conveyancer for legal support. But why is it important to get the right, not only tax structures, but loan structures in place to marry with a tax structure?
Yeah, look, that's a very good point that you raised, Sam. Having the right team behind you is critical when it comes to investing in property. And what we tend to find is that when people are getting advice, they're looking at things in isolation. So, for example, they're looking at a strategy purely from a tax perspective, but we need to look at a strategy from an overall holistic point of view, to ensure that it's a financially effective strategy. Some of the problems that we see, especially when it comes to loan structuring, is people getting their loan structures incorrect from the start could mean a significant loss moving forward. And we're talking potential deductions of $20,000 to $30,000 per year. Just to give you an example, a common scenario that we see from time to time is someone purchases a property to live in as their main residence. They then 4 to 5 years later move out of that main residence and purchase another property and convert that main residence into an investment property. Now, if that loan structure on that initial main residence isn't structured correctly, they essentially can lose out on deductions worth $20,000 to $30,000 per annum because that initial loan structure is not structured correctly.
Yeah, that's right. Because again, there's an overlay here where you got the banks are interested in security, and the tax office has got a different interest of what the purpose of the loan is for. So just because the debt's against a certain property doesn't mean you can actually claim that unless it was for the purpose. So again, might be a little bit complex, but I understand what you're talking about there. But I guess for all our listeners here today, and for yourself or anybody else that might be interested, as Rizwan said, you can't have a siloed approach here. And when you're spending hundreds of thousands of dollars in property, and even into the millions now, it really is worth investing and ensuring you have a team that communicates from your solicitor to your broker, your property strategist, and the accountant, that there is a harmonized and integrated strategy, because it has a significant impact on the upfront taxes you pay, the ongoing taxes you pay, both at a federal level and a state level. But not only that, working with the right accountants and solicitors is also how you transfer that wealth from generation to generation, and minimizes the taxes from intergenerationally. So it's really critical to take the time, and it might cost you a little bit more money at the beginning, a few $100s to a couple of $1,000s from the structure, but as a percentage, it's so infinitesimal. But when you do get it wrong, the monumental cost to yourself or your family over time is significant if you don't get that structuring right. So look, thanks again, Rizwan, today. And I think all I want to say is to anybody listening, or if you speak to anyone, the most important thing is always to make sure you do get the right people in your team to help you with when you're structuring assets or purchasing assets of significant value. If you have a hack at it and you try to take a shortcut, you pay a bigger price. So thanks, Rizwan. Really appreciate your input today, and we highly recommend Rizwan to anyone who's looking for a really professional, not only tax accountant, but he's very commercial as a business accountant as well, and he's come highly recommended to us. And I was actually introduced to Rizwan through a client of mine who is, or a mutual client, who runs his own business, very successful, who'd gone to a number of accountants, and he'd done a bit of research and found Rizwan. And when I'd spoken to Rizwan, I've met a number of accountants over the years, and some are very conservative. They're backward looking. They're not so commercial. They just do tax returns, where Rizwan's all about growing businesses, and I'd highly endorse him for anyone considering a good professional tax advisor or business advisor. Thanks, David. I'll hand back to you.
Thanks, Sam. Thanks, Rizwan. Well, just quickly before we do close out, we had a question here that I'd like to pose for you both. Questions come in that we've just built duplexes and had a handover in May 2020. Is a depreciation report still necessary for this financial year?
Definitely would recommend one, considering it's a new build. Having said that, because they've built the property themselves and they've got a contract in terms of the build price, they may not need a quantity surveyor to actually go out there and work out the depreciation. The depreciation can be worked out from the actual build contract. But even though there's 1 month in the financial year, considering it's a new build, it's definitely worth their while to claim that depreciation.
Oh, that's great. Well, that's a very timely then, isn't it? So that's excellent to get that insight. And I think just following on from Sam, I just want to extend a very warm thank you to Rizwan and his business, ITrust Tax and Accounting. We'll get that out right, forgive me. Do a wonderful job. And look, I guess probably as we've learned today, this is complex. I think for anybody of us that do have properties, maybe more than one property, or looking to build a portfolio, there's been some really great insight here and understanding that there are complexities with it. And I think when Sam started to really touch on the piece around having that right expert team, that's so important. And I think from our perspective here, we're absolutely welcome to speak to anybody here who's looking to understand more about how to make their investment work harder. And we're more than happy to obviously put you in touch with Rizwan and his team as well. It's very easy to get in contact with our team. If you haven't got the contact details, it's hello@dpn.com.au. Our team are available business hours, Monday to Friday, and we'd love to have a chat to you about your investment, what you're looking to do, and obviously making sure that you are getting the very best returns from your property and your portfolio being in the long-term strategy. So at that point there, I'd like to say, again, thank you to Rizwan and to Sam. It's a fantastic session. I'm sure we've all learned a lot from today, and it certainly sets us up for the first day of the new year, as we say. Happy New Year's to everybody with that in mind, and we look forward to talking to you again in the future with our next in our webinar series. So thank you for your time today.
Thanks, David. Thank you, everyone.